Few weeks ago, this crazy story about Wells Fargo closing down all its lines of credit came out, and it shocked an awful lot of people. People who had taken on debt from Wells Fargo were without warning told that the bank would be cancelling their accounts in just 60 days and that their previous agreements for repayments and interest rates were void. To make matters even worse, those who had lines of credit with Wells Fargo will see their credit ratings fall as a result of Wells Fargo actions. Wells Fargo CEO Charles Scharf issued the statement that this was to allow the business to concentrate more on credit cards, but the reality is that Wells Fargo are a struggling business and have been hit much harder than most other banks over the last year or so. In 2018, a news completely went viral that Wells Fargo was allowing millions of unauthorized bank accounts to be opened up and for debt to be piled onto people without their knowledge. Now this had been happening since as early as 2002, but Wells Fargo had just ignored it because they were making money. So they were fined over $140 million and had an asset cap placed on them, which forced them to rebalance their books. Previously, they cancelled home equity lines of credit known as HELOCs car loans, and now also personal lines of credit as well, all in preparation for shaky market conditions. There's no doubt that Wells Fargo are preparing for a credit crunch, a market crash, sustained inflation or higher interest rates. But they are not the only bank taking drastic measures. Just last week in the UK, Tesco Bank announced that they will be closing all 213,000 of their current accounts and that all of their customers will have to move to a competitor. Tesco claimed that this was to concentrate on the part of their business that best meet the needs of their customers. But the reality is probably more worrying. On the contrary of all this, media is telling us that the economy is booming. The stock market's up record amounts, the housing market's up record amounts, and we have fully recovered from the pandemic and the lockdowns over the last year. But the market is telling us that this isn't the case. The news that the world's governments and central banks are giving out, you would expect banks to be trying to expand their offerings to get more customers, not to run them off and refuse to do business with them. Now onto the Mortgage Credit Availability Index. Basically, this is a measure of how easy or difficult it is to get a mortgage or a line of credit. The higher the measure, the easier it is to get a loan, and the lower it is, the harder it is to get a loan. The data clearly shows that it has gotten far harder to find a mortgage over the last year, and it seems like it's going to keep getting harder as well. In the early 2010s, when the world was still reeling from the housing market crash and was in the middle of the credit crunch, it was very difficult to get a mortgage or a loan. The banks required you to have a good down payment, a good credit score, a good history of paying down your debt, and a regular and high income that would easily cover any repayments. This was because the banks were afraid of lending out too much money on homes or assets that were not worth what they thought they were, and to people who couldn't pay them off, which is exactly what happened in 2008. But as the economy started to move again, as people got wealthier and the housing market recovered, the banks got more comfortable lending money again. The requirements loosened and people bought more homes. People took out more loans for cars or for home improvements. We can see very clearly the index rising from 2014 and onwards as it gets easier and easier to acquire debt. But then in 2020, the world shut down and the index collapsed almost overnight. Every bank in the world thought a market crash was imminent and they tightened their lending policies. They stopped giving out loans as they were afraid that no one would be able to pay them off. They were afraid that the assets they were backed against would collapse in value. This is shown very clearly by the sharp and almost instant decline in the index. So now we'll discuss about what are the banks afraid of, what is causing them to tighten their lending policy and to stop taking the huge profits that come with lending money. Well, the sad reality is that there are a bunch of things that are spooking the markets right now, and it's very difficult to know which one the banks are worried about. The most obvious threat is the end of the eviction and foreclosure moratoriums that are in place not only in the United States but in countless other countries around the world as well. Essentially, governments saw that millions of people were unable to pay their rent or their mortgage payments when the economy was shut down and people were prevented from working. In order to stop millions from losing their homes, the government simply made it illegal to evict tenants or to foreclosure on homes. Now in the short term, this worked. It meant that the housing market wasn't flooded with the supply and prices didn't collapse like we saw in 2008. It meant that the rental market wasn't oversaturated and there were not millions of families forced out onto the street. But it didn't solve the problem. It merely pushed the burden onto someone else's shoulders. Those who haven't made any repayments on their home over the last year will at some point need to be foreclosed on. And those who haven't paid rent over the last year will at some point need to be evicted. When the moratorium on evictions and foreclosures end, the crash that the government claimed to have avoided will surely arrive. Regardless of what anyone says, banks are scared of what this could do, and it echoes like the crash of 2008. Home prices could plummet and banks could be unable to get the money they are owed. They may be forced to sell homes at 30, 40 or even 50% discounts just to recover some of their capital. But that's not the only thing that banks are really afraid of. Inflation is really high, higher than we have seen in years. And it just seems to be getting more worse in the future for pretty much all of 2021. The Fed and Jeremy Powell have been parroting just one thing, that inflation is transitory, and it's not worth worrying about, according to them. But so far, the Fed has been totally wrong. They have consistently underestimated inflation and have failed to meet a single target this year. Those who used to believe everything the Fed told them, like Meet Kevin, have now started considering the possibility that inflation is actually here to stay. And for a bank, inflation is not a good thing. Inflation erodes away debt and is great for those who have picked up too much debt. But it is a killer to banks and those who lend. This could be one of the reasons banks around the world are reluctant to lend. Interest rates are low and the inflation rates are high. When a bank gives you a 2% loan on a house, in real terms, they are losing money. Lots of people are looking at the bond markets to try and confirm their belief that the inflation is transitory, but perhaps they should be looking to the credit markets instead. The stocks have done well, the housing market has done well, and the GDP growth has been high over the last year. But the reality could be that this is all just a spike before the crash, and we could enter what's called a double dip recession. The GDP of most countries in the world is still below their pre-COVID levels, yet the stock markets are up 40%. The companies that make up those markets are by and large still below their revenue and profit figures from before the lockdown started. Yet their market caps have all increased. The housing market is soaring, but it's propped up by ridiculously low interest rates that have nowhere to go but up. Unemployment figures in the United States have stopped falling and are actually rising again. After looking into the data behind our economies, it quickly becomes absolutely clear that things are not as great as Biden and Jeremy Powell are telling us they are. I know that now you must be worried after hearing all this, but don't worry. Now I'll tell you some simple strategies to safeguard yourself over these hard times. Just avoid taking on any unnecessary or high interest debt. You should be making concerted efforts to pay off any high interest debt that you don't need. You should be living within your means and ensuring that you have a solid emergency fund if needed. Avoid overpaying for homes when you already have a perfectly fine place to live. You should be aware that the government can't delay the inevitable forever and that at some point there will be another crash, but that will be fine as long as you are not trapped in a vicious debt cycle. What a beautiful information this is, right? If you agree with me, then please let me know your thoughts in the comment section below this video. I feel it really very good when you share your feelings with me in the comment section. That means all to me. And please do like this video, share it into your financial community and subscribe to our channel for more such fascinating videos. Bye bye and take care.